welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Ron Bertino. Today we're going to be talking about weighted Vega, but before we get into that, we have a quick disclaimer. The Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, I will stop sharing, give you the ball, and Ron, welcome. This is the first time I think you've spoken on the roundtable, so maybe take a few minutes and introduce yourself to people who don't know you.
Sure thing. Okay, I think quite a few people here probably do know me or of me, I guess. I've been in the community for quite a while, various different communities that are out there, studied under various different gurus and all this kind of thing. Looked into the entire, index trading like most of us do. Then found that there was what I considered to be anyway a big piece missing, and to me that was the technical analysis component. So I the last year or so, I've been off getting into that pretty hard, and that's a huge field. There are just so many different ways of doing technical analysis, and that's been interesting. Trying to go through all these different models and finding indicators that you're comfortable with and stuff that kind of feels right for you and is accurate, obviously. And now that that's, I'll say, done. Of course, it's never done, right? But now that I've got something that I am comfortable with from a TA perspective, I've now come back through to the index trading. Doesn't mean I'll leave directionals, but I'll essentially be doing both. But now I feel much more comfortable with trading as a whole with index trading, even though it's meant to be delta neutral. I think having the TA component there is really important personally. So that's kind of been a little bit of my past. I'm one of these engineer types, as some other mentors like to call them out. I kind of really get into getting the analysis of things properly understood and breaking things down and fully understanding every little tweak in programs and how things work from an options theory perspective. So that's how I kind of came across this weighted Vega issue when I was trading calendars. I found, like most people, it's kind of strange, right? You get strange behavior and you get frustrated, and that's kind of what got me started looking into to try and understand, all right, what the heck's going on here? Surely there must be a way to understand why things are getting thrown around so much, and started doing some digging. And around just over 2 years ago, actually, I did my initial presentation in another trading community on this topic, and it was considered so controversial, people got kind of upset, to be honest. And I
heard about that.
Yeah, it throws, as you'll see in this presentation, I'm actually taking this presentation even further than my prior one, as you'll see, and it's wacky stuff. It really is, and it really throws conventional teaching theory not necessarily out the window, but you really have to reanalyze. And what the simulation software tells you a lot of the time is highly inaccurate, and that's not a knock on the software because all of the software does it, right? OptionNet, TOS, any broker you use, they will all have this issue because nothing out there does weighted Vega, not even OptionView. Right? I know some people in prior recordings have said, oh, OptionView does it. It doesn't, not yet. I hope they add it, but it currently doesn't. It does display what they call the cone and so on, so you can actually see term structure and see the term structure skew, if you like. So that's good, but it's not implemented into the calculations of the T+0, right? So this is something that we can talk about when I get in through to the options analytics comparisons and all that kind of stuff in a separate session. So this session here is going to really focus on weighted Vega and related issues. And again, I think you'll be very surprised with some of the things that we go through here. And my mission is to try and challenge you, right? I'm a believer in, trust no one kind of stuff, right? I don't care who the guru is. It's fine. Listen to all the theory, but then test it out yourself. Make sure it actually works, right? And the same thing goes with me. Don't trust anything I say, right? I'm going to put some ideas out there. Some will blow your mind, and you won't believe me. and I'll encourage you to go out and do your own testing. I'll show you how to do it as well, so that you can do the testing by yourself and validate what I'm saying here, or not, right? But I think it will definitely change the way you look at things for sure, right? Okay, so let me share this thing out and get started.
Look forward to it. Sounds interesting, Tom.
All right, so let me know if you can see the screen.
Yep, sure can.
Perfect. All right, so as I've mentioned, we all kind of go through, those of us that have tested calendars out typically find that we have some kind of emotions, and those emotions kind of look like this a lot of the time, right? So things are frustrating because we can't understand why, if the software told us we were going to make money, we're now losing money, we're not making money, or vice versa, right? So we thought we're going to lose things, and suddenly we're up and going, hey, everything's great. But you need consistency, right? You need to be able to understand why calendars in particular work in a particular way. And whenever you're mixing two separate expirations, that's where weighted Vega rears its ugly head and whacks you on the head, right? When you're dealing with single expirations, if you're relatively close in time, let's call it 30 days, then the impact of weighted Vega is almost completely muted. But the second that you start stepping out in time, even if you're doing a single expiration, something like an iron condor, it will affect you. Okay, so if you start going up beyond, let's say, 60 days, right? But 60 days being inclusive of that, which lots of people do iron condors, 60 days out. So that's the kind of stuff that we'll actually look at. So hopefully we'll change the emotions from this guy through to now understanding what's actually going on. Now, the concept of weighted Vega is actually extremely simple, right? So, but the impacts are massive, especially if you trade calendars, right? So I thought I'd kind of just do a little analogy there, because sometimes the analogies stick better than the options theory, okay? So here's my little analogy. So we've got, person number one is driving along the freeway. Let's say they're driving, 80 miles an hour, what have you, and that person is this guy over here. Now this here is a Toyota Mini Vega car, okay? Tiny little thing. And what happens is that this doofus in front of you suddenly sees a pigeon or something and decides to slam on the brakes, right? Now what's going to happen is, no surprise, you are going to crash, okay? Does it matter that you're driving a little Mini Vega? No, right? The distance to the event is really close, and you're going to slam into this guy, and you're going to get hurt, okay? So that is person number one. Now, person number two is driving what we're calling here the Vega nuclear intercontinental ballistic missile. Okay? Now, this person is going to be driving on the exact same freeway, right? But the difference is that even though they're carrying a nuclear weapon here, right, the difference is that they're also carrying an iPhone. And on their iPhone, they basically get an alert, and that alert basically tells them, hey, there's been a crash. That crash is almost 200 miles away, and you're going to hit that within roughly the next 3 hours. Okay? Does this guy give a damn? No, right? Do we care that he's driving a nuclear missile? No. He's got plenty of warning, all right? So that, due to the fact that the distance to the big event is so far away, it's not going to affect this driver, almost in the least, okay? Regardless of the fact that you're carrying a nuclear weapon compared to driving a little tiny car. All right? What matters is the distance to the event, right? So in other words, what we're talking about here is the ripple effect, right? If you're close to the event and you're standing here, you're going to get that big wave hitting you, right? But if you're way out here, this wave is very, very, very muted, right, in comparison. And that really is the concept of weighted Vega, believe it or not, right? It sounds completely logical. You go, yep, sounds fine, right? But again, when you start applying this to the concept of real trading, then that's where you start seeing some very interesting effects. All right, so here we go. Now, in this example, what we're going to look at here is a scenario of, we see where price is going, so you can see that on the chart, And then we have, so that's price over here, so you're not used to this thing. And then this second line over here is implied volatility. Okay, so here what we're going to look at is what's going to happen if price is going to now tank. All right, so our expectation again is that price is going to tank and IV, so this line over here is actually going to pick up. All right, so IV is going to increase. So the first thing to look at is just the option chains, right? So what we're going to see here is we're going to be looking at both the mid prices and see how they get affected across the actual different expirations, right? So as we go to the right, we're heading out further out in time. And we're also going to be looking at the Vega component, okay? And the Vega component is, we would expect this Vega component to increase, right? Because with a crash, IV is going to go up, and that's going to therefore increase our Vegas. Right? Now, if we look at that in terms of reality, this is the kind of thing that we get, right? So I've included the screenshots there just to show you I'm not making stuff up. But we have, you know what, sorry, let me just, I was going to quit out of Skype so you don't get the little alerts. So, so now what's going to happen is that if we basically look at what happens through the different expirations, so you can see here we're basically going out further out in time. So our original Vega is this particular column, and then we've got the new Vega. But the most important thing to look at is how things are changing. And if you look at this, you can clearly see that the Vega, when you're close in at 31 days, which is this guy, is going to be affected much more than if we are at just 90 days, okay, by a huge factor. Right? And again, this is the concept of if you are close to the impact zone of wherever something is happening here, it's an event that happens at a particular point in time, right? So if you're close to that event, you are going to get whacked, right? Remember, it's that mini Vega car slamming into that truck, right? But if you're further away, right? This was the iPhone example that you've said, oh, I'll be there in 200 miles in 3 hours. Who cares, right? The impact is minimalized. Okay? And the same thing is not just looking at the Vega. If we look at the actual prices of the options themselves, right, and these are puts, so you can see that, you know, the one that's closest is going to absolutely skyrocket, right? Yes, the ones further back are still affected, of course, right? But you can see here that the further away we get from that event, from a time perspective, the less the impact is even on the price perspective. Okay? Now, and remember that when we're looking at price, we're basically looking at multiple Greeks all blended together, right? It's not just the Vega component, it's deltas and it's everything else, right? So that's why it's important to kind of focus primarily on this, because our focus here is what's the impact from a Vega perspective, right? We don't necessarily care about looking at deltas and mixing all those things up, because then that gets complicated. We want to isolate just the Vega. Therefore, even though you can see the impact on price, the most important thing to look at here is the percent change of the Vega itself. And you can see that if we're looking at this and comparing the these numbers, right, as you can see in the thing that's written down here, even though the 3-month option from a Vega perspective has 2.8 times more Vega, it's affected 3.6 times less. Okay? And this is the key to essentially what's going on with weighted Vega, right? Again, the concept is simple, right? And even you might look at this and go, oh, that's nothing mind-blowing, right? That's kind of understandable, right? But the second that you start applying this through the real trades that you do, that's where you start kind of scratching your head going, what's going on, right? And a lot of the time, what's going on is weighted Vega. So that's really what we're trying to look at, right? So basically saying, so what, right? This is just geek theory, right? Geeks talking about Greeks, right? So how does that affect us? So I thought an interesting thing to do would be to look at what I'm calling here myths versus facts, okay? And we're going to be looking at a whole bunch of scenarios of conventional things people teach, and then we're going to be looking at, all right, what happened in reality, and then we're going to be trying to understand why that occurred, okay? So let's get started. First thing, a long-term calendar is going to give you more long Vega exposure, right? So another way of saying this is that if you buy a calendar that's further out in time, you've got a much bigger Vega component, and most people would say risk, right? You're betting on volatility going up in order to make money. And with a big Vega, if you go out in time, if volatility goes down, that's where you start getting hurt, right? And sometimes pretty significantly, okay? So the concept is if you're basically betting on the market tanking, right, you might say, well, I'm going to go way out in time, buy myself, leaps, right, from the back month for a calendar and just go, buy a calendar way out in time, and when the market crashes and goes down, volatility is going to skyrocket, and I'm just going to become a millionaire, right? Well, let's look at that. So here we're basically going to have a crystal ball. We are going to place the perfect trade at the perfect point in time, right? So what's happening is that we've had a nice run of the stock doing whatever it wants to do. We're at, let's call this some kind of resistance, right? Doesn't matter about TA though. What's actually going to happen, because I do have a crystal ball, and what's going to happen the very next day is this thing is going to tank, right? And you can see that on the next slide, on the right-hand side here, right? So over the next 2 days, we get huge movements down, right? And we get the RUT moving down by 40 points in 2 days, and the volatility increasing by 2.54 points. Okay. Now what are we doing? We're actually we're going to be setting up a calendar here, right? Basically 20 points down, so 20 points out of the money, so it's a directional calendar, and calendars are, of course, positive Vega, right? Meaning that when we get an increase in volatility, we're going to be cashing in. All right, so this is the perfect trade, right? So my crystal ball tells me market's going to crash. Fine, I'm going to go in, I'm going to put in a calendar, right? So we're going to look at 2 variations. First variation over here is let's call it a standard calendar, right? Typical 30-60 type of calendar, right? The short is 30, in this case, 31 days out. The long is 59 days out, all right? Now, what we're primarily betting on when we're placing the trade, not only is it 20 points out of the money here, but what we're betting on is this thing down here, right? We are betting on the fact that this thing is positive Vega. So again, when Vega increases, we're going to make a killing, right? Now, the Vega in this perspective basically says it's 453. So what that implies is that if we know that the IV is going to increase by 2.5 points, then we basically grab this number, we multiply that by 2.5, and that is the amount of money we're going to make from a volatility perspective. We may make more or less money depending on the delta movement, right, during that move, but from a Vega perspective, we basically should be making, close to $1,000 over here, slightly over. So let's look at that. Now, one of the limitations of this particular modeling software I'm using here is that when you want to simulate adjusting the volatility, it doesn't allow you to go to decimals. You can only increase and decrease volatility by single points. So what I've done here is I've basically split this thing in two. So the one on the left is increasing volatility by 2. The one on the right is increasing volatility by 3. Okay, and that's obviously going to give me a pretty close average to what a 2.5 point increase in volatility is going to give me, right? So I look at that, I basically say, all right, price was actually originally here, and then price has moved to there. Now let me just briefly explain why I chose this strike that's 20 points down from the money. What I was trying to do is to isolate the Vega Greek. What I mean by that is that I wanted us to make money on the way up for the deltas, and I purposely wanted us to lose money on the way down. The point being is that I wanted the delta to roughly have been isolated such that when we move from here to here, we're essentially back where we started from a delta perspective. Okay, I don't know if that's confusing, but that's basically why I chose that particular strike. So this allows us to isolate Vega to see the true impact of Vega. Okay, so on the left-hand side, we've got a profit simulation of 829, which would basically be this point. Whoops, that point right there. And then this point over here on the right-hand side gives us a simulated profit of 1283. We average these two out, and we get a simulated projected profit of about $1,000. Okay, so let's look at what happens in reality. All right, so this is reality. Reality is we're basically making less than half of what the software predicted. And again, this is not knocking this software, because every simulation software would have told you the exact same thing. okay? This is just that nobody has coded weighted Vega yet. So this is the results, right? So we went from making a pretty handsome profit there of over $1,000 down to essentially half of what we expected to get, right? Now remember, this was with the 30-60 calendar, right? So you might look at this and you might say, all right, had I been smart enough to put my back month option further out in time, that would have given me more Vega, right? So let's look at that. So now what we're going to do is that we still choose a 31-day front short option, and now our back option we push much further out, so 122 days. Okay? What that does is that it has the effect of increasing our Vega significantly, right? And you can see here that our Vega is now 2.5 times more than it was with a 30-60 calendar. Okay? Now, the impact of this here is that you might say, well, is this a smart purchase, right? So you might say, well, okay, my Vega is increasing by 2.5 times, but what's my cost, right? Well, my cost is 2.7 times more than the other calendar. So that's not too bad, right? So it's equivalent, right? I'm willing to pay more in order to increase the size of my bet on volatility going up, right? Because I think the market's going to crash and IV is going to go up, and therefore I want to cash in on it. Great. So our projected profit, I won't bore you with the screenshots, okay, but our projected profit is now $2,500, all right, for that same drop. Let's look at what happens in reality. All right, so again, predicted profit, $2,500. Reality, right? Reality is $271 profit compared to the $2,500 we thought we were going to get. You might go, hang on, something's wrong, right? I've just bought a back month option that was further out in time. Vega was much bigger, right, than the other one, so what the hell happened, right? So let's actually see these things side by side. All right, so there you go. Monthly calendar, which was the 30-60, right? Cost was close to 10 grand. Over here, campaign calendar, 2.5 times the price. That's fine because what we were actually doing was we wanted to increase our Vega exposure, right? We wanted to be very long Vega. That's why we paid more than 2.5 times the price. But look at what happened with the results, right? The short-term calendar made 6.7%. The long-term calendar we thought would be making a killing in made 1%. Okay? And you go, what the heck's going on? Right? This is exactly what I'm getting at. This is weighted Vega, right? The further out in time you go, the more weighted Vega is going to affect you. And if you have split expirations, as you do with calendars, that's where weighted Vega comes and hits you on the head if you don't understand what's going on. Okay? So we had this fact versus myth, right? A longer-term calendar will give me more long Vega exposure. Well, the raw Vega, as in the number that you see in the simulation software, is definitely going to be higher, right? But it's not going to give you the dollars you expect at all. Quite the opposite, right? So fact versus myth, busted, right? Wrong. All right, look at the next one. Very similar now, right? I'm bearish, so essentially I'm going to go way out in time. I'm going to buy massive amounts of Vega, right? Having my back month option with something like leaps or something like that. And we're going to cash in, right? Now, I'm going to go now take this thing to the next level. We're going to look at the concept of how we can actually look at weighted Vega. And there are various concepts out there. Having said that, there's hardly anybody out there that actually understands weighted Vega, right? Nassim is one of the few people that do and wrote a book on it. He actually shows about 3 different models of how to calculate weighted Vega. And this is what he calls a simple model, right? It's a very easy calculation, even though it may look weird, right? But it is a decent way of trying to estimate weighted Vega, right? So let's look at this. What this is saying is that our true Vega, as in our weighted Vega, is base DTE, right? So what the hell does that mean? I'm actually going to skip through this, and I'll come back. You know what? Let me just say, I'll put in the number 30 in here, okay? I'll come back to that in a second, though, because it's actually irrelevant, but you'll see what I mean in a sec. So base DT is 30. This DT here is the date to expiration of the option that you're actually looking at, okay? So, and you look at each individual leg. So if the long leg of your calendar is 120 days out in time, then it would be 30 divided by 120. Okay? Then we're taking the square root of that ratio, and then we're multiplying that result by the raw Vega. What's a raw Vega? Well, if the software that you're using, be it TOS, Interactive Brokers, doesn't matter, right? If basically it says, all right, I'm buying one particular option, this is at 120 DTE, and if you look at the Vega column says this has a Vega of 120, right? Then the raw Vega is that. It's whatever the software tells you that the Vega is. Okay, but we call it raw because it's unweighted. Okay? But this is the standard number that you see in the software. So going back to it, if you had this 120 one long contract, you'd say 30 divided, and it's always 30, right? Divided by the DT, be 120, square root, multiply that by the raw Vega. All right, and that will give you a weighted Vega number. All right, first up, any questions on that? Okay, so let's start with that, right? And now let's look at some spreadsheets, all right, that will do this for us and give us some pretty interesting results. And I know a question will come up is, can I get my hands on the spreadsheet? The answer is yes. All right, I'll provide that at the end. So first thing, what we're looking at here is we're looking at the DTEs of different expirations. And I pulled this like 2 days ago, okay, into this particular spreadsheet. So they're all very recent numbers. So we've got the dates to expiration of each option, I guess, and then what the actual raw Vega is of that particular option as shown in the software. Okay, and then what we're doing here is that we're using that formula from the prior slide to figure out what the real weighted Vega is, and then what this column over here, the percent diff, is that it compares the raw Vega to our weighted Vega, right? So, and this really is the line that I think is interesting. Okay, so all of this kind of stuff going all the way through. So as you look at that particular line, you can see that as we move out in time, the differential between what the software claims and what the real weighted Vega is becomes much, much bigger. Okay? And this is the ripple effect that we talked about before, right? So if the crash happens here, then if you basically go out a year, that is hardly going to get affected. Or at least in this simulation, it's saying the impact will only be 1/3 of what the software is claiming to tell you. Okay? The closer you are to that event, the more you're going to be affected. So the more accurate the raw Vega number is. The further away in time we go, the less accurate the raw Vega number is. Okay? So that's what that top section there is. Now, this section down here is I started having a look at variations of calendars. So over here we've basically got the 42 DTE versus the 70. So this means that our short would be in the 42 and our long is in 70. Okay? And I thought that would be interesting because, and over here what we're doing is that you can see here that I'm basically looking at expirations that are together, right? So over here we've got these two, right? And then if I look at the next row, I start widening out the expirations over here. So here we've got 42, and now I'm jumping over through to that, right? So I'm now 2 expirations apart. Over here, I'm 3 expirations apart, 4 expirations apart, 5 expirations apart, okay? So that is now going to give us quite a spread then, or you know, a mix of not just looking at calendars, but looking at calendars that have different widths and different points in time, okay? Now, here's the first thing that I find perhaps not quite accurate with, well, I think I saw a comment saying lost audio. Can you still hear me, Tom?
Yeah, you're fine. I'll
okay.
type in instructions for Jay.
All right, they're fine. Okay. All right, so the first key over here was, as I've mentioned, the further out in time we go, the less accurate the raw Vega is, right? The second thing, though, that to me sticks out like a sore thumb when I look at this thing is the similarity of all of this stuff here. Okay? Now, what does that mean? If you look at these numbers, what this is basically telling you is that the real weighted Vega of all of these different options is more or less Vega neutral. Okay? So what this is saying is that by using Nassim's formula, which is relatively accurate, then what is going to happen here is that whatever calendar you're going to be looking at, once they are beyond the 30-day point, they're going to be relatively Vega neutral. Okay? So you might think, well, doesn't that kind of conflict with what I said before, that if you go out by a year, then there's still an impact. The impact over here is 30%, right? Yeah, but that's only one leg, right? If you then compare, if you were doing your front leg here and your back leg here, now when you combine these two things together, because remember, you're selling one and you're buying one, right? When you combine these two things together, then you're basically getting numbers that are quite Vega neutral, right? And that is a pretty big deal, right? That means that the types of things that we're taught in terms of calendars are long Vega trades, if you purely look at this information here, which I'm not saying is dead accurate, right? But I think it's closer to reality. And that is that these particular numbers are more Vega neutral, right? Now, these, what I've done over here on the right-hand side is I've shown a variation to the spreadsheet. Now, let me show you the spreadsheet now. It's this guy. All right. So this is the information that that we just talked about. All right. Let me kind of bump it up a little bit. All right. And so now the first thing about this is looking at base DTE, right? Because when you look at, if you recall that formula that we looked at before, Nassim in his book basically uses 90 days as his base DTE, right? There are other mentors out there. I mean, I'll say it, right? So Mark Sebastian from Option Pit, right? He loves using 30 days, right? So he always uses 30 DTE as his base DTE. And there are plenty of people out there that actually just use one, right? A single day. So you might say, which one is correct, right? Is it 30? Is it 90? Is it 1? Right? Does it actually matter? Well, we can actually look at that, right? So this over here, you can see here that the formulas are already all, you know, it's not static numbers, okay? These are actually formulas. So if I change, and I want you to keep an eye on this type of data here, right? Basically, all this is saying is that it's relatively Vega neutral, right? So I'm going to change the number from 30 to 90. Big change? No, right? It's almost identical. I'm going to now change this base DTE to 1. Big change? No, almost identical, right? So nutshell, base DTE doesn't matter. Not for this formula anyway, okay? So that's one thing, I guess, to kind of look at. So that is one model, and you know, the accuracy of the model is debatable, right? I've personally seen through my tests that, and I'll actually show you, that by even using this simple model over here, you're going to get much more accurate calculations than you do using just standard raw Vega, okay? Even though some people say, and I've seen some comments fly by going, it's not quite accurate. Well, fine, but it's more accurate than what we currently use now, okay? Now, first of all, do I personally believe that every single variation over here is going to be essentially almost completely Vega flat? No, I don't. Right? So that's why I'm basically saying that this is not a perfect calculation, and to my knowledge, there is no software out there available to the retail public that can provide more accuracy than this kind of stuff here. Okay? But it's much better than what we have, right? Again, now, Nassim does present more complex models, but they're complex, right? So it's not something I can simulate in a spreadsheet, at least I don't know how. So this is pretty good, I think, good enough. Last thing over here is something that you can essentially use you've probably seen something almost identical from Paul Demers, right? When he did his presentations on wanting to know what can he change his TOS inputs to when he's basically putting in a calendar, right? So again, the way that works over here, anchor DTE, if you recall, more or less irrelevant. Use 30, use 90, use 1, use whatever the heck you want. It will more or less be the same, right? I've just chosen 30. Then if you want to simulate the vol change going up by 1 point, you stick a 1 in here. So any cell that's yellow, this is where you can specify your own inputs. All right? Don't change these guys or these guys, only change what's yellow, right? So you would come in here, you type in 42, and then 70, which are the expiration for your short, expiration for your long. From a DTE perspective, you enter the raw Vega based on what the software is actually telling you, okay? And then this thing will then work out what the weighted Vega is and tell you, in this case, that that particular calendar is relatively Vega flat, all right? Now, that's interesting, but it doesn't help you simulate stuff on TOS, right? So on TOS, if you go in and you click on that little chevron type of icon that allows you to change the different expirations, you can, let me show you here. Let's go further out in time. I'm just going to bind out the money calendar. I don't really care about the expirations for now. All right, there's my thing. So if you were to click on this little cogwheel, you get the ability to change your vol, right? And you can say, all right, let's increase my vol by a point, right? The problem with doing it this way, though, is that it increases the vol uniformly across both options, right? Both across my October short, and let's push this out to December. Whoops. Why is that not liking it? It's not letting me change expiration. All right, doesn't matter. But it will basically do it across both of the expirations, which we actually don't want, right? Because remember, weighted Vega means closer to the impact zone, right? Means you're affected a lot. If you're far away, it doesn't affect you much, okay? So doing it that way will not give you good results. And this, by the way, is what pretty much all software does. It allows you to change the volatility for both legs at the same time. Now in TOS, we can click on this little chevron and drop this thing down so that we can then tweak the volatility of each. The trick, though, is that you might say, how do I know what if the front one increases by 1, what's the back one going to increase by, right? Well, that's what the spreadsheet is going to tell you. So in this case, if you had a 42 and a 70 using these guys, it's going to tell you that it's going to be relatively Vega neutral. But if you want to simulate this on TOS, then for the front month, you'd set this to 1, and the back month, you set this to 0.77. Okay? So you go over here, and you change this to 0.77. And that's now going to give you a more accurate representation of what your T plus 0 is going to do. Okay? I'm saying here, calendars are Vega neutral, right? Should be, hopefully, a controversial thing, right? I like controversy, right? So let's do a quick kind of analysis here. I know it's a lot of text, sorry about that, but can't be helped in this case. So if you recall from the prior example over here, we're basically showing this longer term, let's call it a campaign calendar that had a back month option of 120 days out. Okay, let's look at if we can get more accuracy with weighted Vega, right? So here, the software was simulating a profit of $25.88, yet we only got a profit of $271, right? Well, if we look at this, we had a 30 DTE option, and if we use the static model, right, that lookup table, but you can absolutely use Nassim's model as well, which you'll see on the next slide, right, and so you can compare the two. So here I'm first going to use a static model. So the Vega divisor is 1.2, so what for that particular option, right, so what we're actually going to be doing is we grab the raw Vega of that option, we divide that by 1.2 to figure out what our weighted Vega is for that leg. Then we grab the raw Vega of the back month option, which is at 120 days out. The Vega divisor for that was 2.3, so we divide that by 2.3. That gives us a weighted Vega of 97. All right? Notice that if you now compare these two numbers, the differential is only 7. Right? Your weighted Vega is only 7 for that particular calendar. We have 10 contracts, right, in this particular trade, so we're multiplying 10 by 7, right? That's going to give us a position Vega of 70. Okay. Now, what did IV do? IV basically went up by 2.5 points. We have 70 positive Vega, right? We're multiplying that by 2.5. That gives us an expected profit based just on Vega of $175. Okay? So I know it's a bit of kind of math, right? But again, you'll have access to the slides and you'll have access to my report and all that kind of stuff, right? So now if we look at this, software, all software out there would have predicted you're going to make $2,500. A very quick calculation over here, which you'll now have a spreadsheet for, is going to tell you, nope, you're going to make 175 bucks, right? Which one is closer to reality, right? Weighted Vega by a mile. Okay, so is the model perfect? No, right? Is it far more accurate for doing these kinds of things? Absolutely. All right, so let's compare this through to Nassim's model, right? Well, in Nassim's model, you plug that into the spreadsheet, and that tells you your weighted Vega is 4, right? The other static model that we looked at before said your weighted Vega is 7. Either way, either one of those two models gives you a much more accurate estimation to what your profit would have been compared through to raw Vega. All right. Any questions on this part? Did I lose people walking through this? Again, you'll have access to the slides so you can go through it in your own time. But any?
No, people like it. It looks good.
Okay. All right. So that was that. So second theory here, again, was I'm bearish, so I'm going to load up on Vega by going way out in time. Is that accurate? No. Busted. All right, so next thing, you might start looking at this going, okay, now I'm confused, right? So two myths that were busted here, and so you might think, well, I like to use calendars as a Vega hedge for my other trades. So if you're now telling me that calendars are relatively Vega neutral, that's not good, right? Where's my hedge, right? I need long Vega, damn it. So there are things you can do. Right? So if that's the situation, you're basically saying, how can I hedge my short Vega? Then the answer is add more longs. All right? And there's two ways that you can kind of do this and still maintain positive theta. I'm sure there's a billion ways you can do this, but here's just some of the things that I've come across in my research, right? Based on teachings from other gurus. I haven't invented anything here. I'm just passing on information that I've learned. Okay? So one option here is, even though you can't see the other strikes, but what we've got is we have a more or less at-the-money calendar, right? So our front option, short for the calendar, is in this expiration here, and our long is in this expiration here, okay? And then what we do is that we basically then set up a straddle, right, in order to give us more Vega. Because remember, even though this thing says it's 779 Vega, we now know that's a lie, right? We now know weighted Vega rears its ugly head, and this is basically going to be much closer to flat than 780, right? As crazy as that sounds, right? So by adding additional long options here in a ratio, right? Here I've got 10 calendars, right? So we'll basically, at the relevant strike, well, I would have had a -10 and a +10 like that, right? Giving us that top line, and then you can see what adding a single out-of-the-money option on both sides, on the calls and the puts, that's going to increase our Vega over here to 1,000, give us an extra 300. But notice that it's not going to be as affected by weighted Vega as the other option, because remember, what happens with the calendar is you're dealing with multiple expirations, right? If you're simply adding, forget about calendars for a sec, if you're simply adding long puts, as an example, right, you're going to be long Vega, right? But the second that you then start selling other short puts in front of that, weighted Vega kind of balances these things out such that a lot of the time it becomes Vega neutral, right? So by adding just extra long options, that's an obvious way to bump up our Vega, okay? On top of that, notice that our risk graph looks not bad at all, right? Notice that our theta, yeah, it got chopped down quite a bit, but hey, we're still, making money, right? So we're still making 70 theta a day. And we've, basically capped our gamma risk here as well, right? So if we get a massive move in any direction, then we're not that bad, right? And on top of that, not only are we not that bad, but if we get a massive move, then probably IV is going to go up, and we're mostly long Vega, so the entire line is going to kind of come up, right? So that's one option. This is adding a strangle to the front month, okay? The second option is similar, and what you do, you can see the risk graph looks pretty similar, but what you do here is you're basically adding a straddle at the same strike as the calendar, but in the back month, okay? And in a ratio here, so I'm only adding a single straddle here at the same strike as our calendar, right? So this is 1870, and this is 1870. Okay, and you can see it flattens out our T plus 0 quite nicely. It still leaves us with positive theta, and we have loaded up on Vega even more, which is what we want, right? Remember, we're talking about how can we Vega hedge, okay, our short Vega trades. So I need some long Vega to kind of balance things out. This thing again over here, relatively flat, T plus 0, and we've gotten the Vega hedge that we're looking for. All right, so those are just two ideas. I'm sure there's probably more, but these are the two that I've seen in my travels. So next, facts versus myths, right? So someone using upside, all right, out of the money, upside call calendars is absolutely nuts. Don't they know that calendars are positive Vega, right? Anyone heard that one before? So let's say you're doing something like this, right? You've probably seen Paul Demers kind of do this type of thing, right, where you've got some kind of butterfly on the left-hand side, right, out of the money, and then they decide to put on an out-of-the-money call calendar. You'll also see Tony Sizemore do this as well. Even though I've actually not really heard him talk about weighted Vega, I'm assuming this is why he's doing it, right? So, so what's the point here? The point here is that traditional teaching theory tells you that when you set up a calendar, regardless if it's at the money, out of the money, whatever, it's always long Vega, right? So why the hell would you put one on the upside? Because as price goes up, volatility goes down, right? So you'd be nuts, right? Most people say, no, you put a butterfly on the top because butterflies are negative Vega, right? As price goes up, the IV goes down, butterfly makes money, right? But remember, the point is that calendars are relatively Vega neutral, most of them, right? Therefore, setting up an upside calendar, something that's going to give you, in this case, if it's out of the money, it's going to be positive delta because your delta is going to be leaning up. It's going to have positive theta, right, because you're going to be going towards that tent. And from a Vega perspective, it is not going to be what this thing here tells you. It's going to be relatively neutral. All right, and here's the table comparing that, right? So the software for the calendar alone is going to be telling you, oh, you're going to be having 55 Vega. No, you're not. You're going to have 6. Okay, 12.3% of what the software is telling you. All right, so am I crazy setting up an upside out of money call calendar? No, all right, busted. Next one, this one's fun, right? People say, I've noticed that something happens with almost complete consistency, and that is that IV goes up when earnings are about to come out. And as in, this tends to happen almost every time, let's call it 2 to 3 weeks before the announcement, right? Well, let's look if that's true. Yeah, it is, right? This is IV down the bottom, and roughly 3 weeks leading up through to the earnings event, IV, what's that do? It goes up. 3 weeks, goes up. 2 to 3 weeks, goes up. 2 to 3 weeks, goes up, right? And people look at this and they go, wow, fantastic, something predictable. So what's good when IV goes up? Calendars, right? So I'm going to put on the calendar 2 or 3 weeks before the earnings event, and I'm going to make money, right? What's the problem with that? There is no free lunch, okay? If it worked, everyone would be doing it. But let's take a look in reality. So we have roughly 3 weeks to go. So you basically look at the option chain, you see that, and then you say, what do I do? Well, I need long Vega, right? I know volatility is going to go up, so what's long Vega? Calendars. So we stick on a calendar, right? So I basically sell 10 and buy 10. Our calendar is long Vega, at least that's what the software tells you, and next thing you know, hey, I didn't get the result that I was actually expecting. Why is that, right? Well, the thing is you have to look at each leg, right? And what happens here is that if this is the expiration where your earnings event is going to come out, the IV of this expiration is going to go sky high comparatively, okay? What's going to happen to nearby expirations? They're also going to go up. So you might say, well, calendar will do fine then. Everything goes up. Yes, but not to the same degree, right? So what's going to happen is that this expiration will go up this much in terms of IV. This expiration will go up that much, right? Why do we care? Well, we care because we are short 10 contracts in this month. If we're short 10 contracts, that means we are negative Vega here, and we are positive Vega here, okay? So up until this point, everything's hunky-dory. The second that the IV increases even more on this month, this is pain, right, for us, because we're short that month, even though we're long the back month, okay? This is why this kind of setup doesn't work, right? So those of you that have seen this kind of stuff before basically say, I have the solution though, right? Because what if I do this? Right? So now you're basically looking at it and you're going, okay, same thing, right? So we said this guy's going to go up a lot. This guy's going to not go up so much, even though it probably will go up. So yes, I'm being hurt here, but here, from this point to this point, that's money, right? It's going to increase more. Now, does that have some degree of truth to it? Yes, it does. Okay? So this one does have room, but notice I've left this thing blank. Because if you're setting up your back month at 21 DT, because this is at the point roughly where Vega, or the IV is basically going to start increasing, right? So this is where you basically set your back month long. Some people call it the anchor, right? So you set your anchor there, and at 21 DT, but the thing is, what are you going to sell in front of it, right? If this underlying equity has no weekly options, there's nothing to sell in front of it, right? This one is the front month, and it's at 21 days already, right? Therefore, if you want to do this type of stuff, you have to look at something that has weeklies, all right? So you want to sell something shorter term in front of it, right? But then you've got that final week at which you can't sell something in front of it, right? What does that mean, therefore? Is that you basically have roughly 1 to 2 weeks worth of weeklies that you can sell in front before you can't do it anymore, right? But is there edge? Yeah, there is, in my opinion, okay? So this myth is not busted, right? I think there is validity to this concept, as long as you're anchoring the longs to the back month. So, sorry, as long as you set your back month options to the expiration that is going to increase in IV the most. And that's obvious when you look at the chain, right? So that basically there tells you what I've just walked you through. All right, so that was the first myth that wasn't busted, okay? Next one. Here's a beauty, right? Initiate calendars when IV is low. Tell me that you've not heard this before, all right? Everybody talks about this, right? When IV is low and we expect IV to go up, this is when you place calendars. So let's look at that. So we're going to look at this thing on the right-hand side here, all right? And tell me if you would feel comfortable placing a calendar at this particular point. IV, which is this black line, is at multi-year highs, right? This thing has crashed like, right? Seriously, right? Taking out that bottom level over here, but you're now reaching a point of prior support, and those of you that kind of, study candles, right? You look at this red candle, you go, hey, that's a pretty nice looking hammer candle, right? And that's known to basically be a potential reversal candle, right? But you go, you know what? I'm not quite certain yet. I'm just going to wait a little bit more. So that the very next day, you wait for the next candle. I don't know if you can see that, but the next candle here is actually a green hammer as well. And on top of that, it's an inside day, right? It's basically you've now had 3 candle signals that you're potentially looking at a bottom, plus you've got prior price support, right? So you might say, okay, I'm willing to place some kind of bet to the fact this thing is going to be done in terms of moving down, or it's probably going to bounce, okay? And since the move down has been so hard, it may actually even bounce pretty hard, right? So, but that being said, IV is sky high, right? I'm yet to see any guru out there, with maybe one exception, that would basically go out there and say, put on a calendar when IV is sky high. And your expectation is that IV will drop, right? No one says that, right? It's always the complete opposite. Everyone over here would be putting on some kind of butterfly, okay? Or some kind of, put credit spread, something to take advantage of IV dropping, right? A calendar is the last thing people think of when your expectation is that IV will drop from a sky-high level. Most people think you'll get nuked and killed, right? So let's look at this. Now, this is what our position looks like, all right? We've got 10 contracts. Our Vega is 780, and our expectation is for IV to go down because we're expecting a bounce, all right? So we're pretty insane at this point, right? Thinking, what the hell? Let's just do it for the hell of it, right? Okay, this is what's going to occur. So what's going to occur, again, is we're going to get a drop of IV by about 2 points, right, because we get a price bounce now. Okay? All right. Prepare yourself for loss, right, because what we've got here, remember, we've got 780 Vega. We know IV drops by 2 points. The software, every software out there will tell you you are going to get smashed. You're going to lose 2 grand overnight, okay, if that occurs. And our crystal ball tells us that will occur. Well, let's look at reality. Let that sink in. All right, IV has gone down by 12%, 2 points, okay? We are up there. We are up 42 to 43% in a single day, 5 grand. By putting on a calendar when IV was sky high and we expected it to go down. All right, tell me that doesn't kind of make you scratch your head. All right, so what the heck is going on here, right? It's the complete opposite of what we tend to get taught, right? So that's probably what you're kind of looking at now again, right? What's going on is term structure, right? It's not about the fact that your IV is high or your IV is low. The biggest edge, and this is now opinion, all right? So the biggest edge, in my opinion, that you're going to get from calendars is from playing the term structure, right? Now, normally what's going to happen is you guys may have seen, Tom talk about Big Central and all that kind of stuff, right, where you see, the first month here, the second month there, next month there, and you get like a curve, right, that goes like that. So the further away in time you go, the higher the IV goes, right? So that is normal, and I'll explain why that's normal in a little bit, okay? But the point here is that we now have abnormality. This is before the bounce, okay? So what's happened here is that the IV on the front month, 36 days out, is 17.6, and on the back month, it's 16.96, okay? So we have abnormality here. Normally, the front month should be lower IV than the back month, okay? And we're taking advantage of that, right? So what we're doing here is that we're basically setting up our calendar with the expectation that when things get out of whack, so if we have a term structure that basically looks, that is flat and then starts to kind of do the usual skew. This thing over here is called contango, okay? So the second that we go flat, or the second that this thing slopes up, right, we've basically gone into what's called backwardation, right? But any one of these two is opportunity, right? But you do have to be careful of something which I'll mention later on, right? But when you're basically dealing with indexes, this is definitely opportunity. With stocks and equities, it can sometimes be dangerous if you have an event coming up, right? But I'll get to that. So when you see that, you've got to realize, hey, I know that this is an abnormality. So if I go from flat to then traditional type of skew, the expectation is for abnormalities to go away, right? And most of the time, people tend to completely overreact to things, right? Oh my gosh, the world is coming to an end. Everybody starts buying huge amounts of puts and all that kind of stuff, right? And that sends the line from the front month from looking normal like this through to going flat or even going positive, okay? When you see that, that's potential opportunities for making money with calendars. Now, by the way, can you make money with calendars knowing nothing about weighted Vega? Absolutely. Okay? What I'm trying to explain here through all these examples is the wackiness of calendars that people get really frustrated with and why it occurs, right? But with understanding that, sometimes you can find edge, right? And this example right here, I think is perfect, right? Because it looks completely wacky. No one would put on the calendar when IV is sky high and about to collapse. Yet, you can make serious money here, right? In this particular example. So, and the example is exactly that, right? It's term structure. We're now taking advantage of the fact that we are selling high IV and we're buying lower IV. And our expectation is that this 17.6 number is going to go down and that this number over here is going to go up, or at least that flat line, which is actually now not flat, it's actually skewed up, right? 17 is higher than 16. It's currently skewed up. Our expectation is for this to occur, right? So for the front month IV to go lower than the back month. However it wants to settle, we're going to win in that situation because we are short the front month. We are short Vega. We want Vega to go down, and we want the back month Vega to go up, okay? And that's exactly what occurred. That's why we got this profit, because now, look at this and look at that, right? Front month has now gone down to 15.6. The back month has gone to 17.8. Now, could you stay in this particular calendar going, sweet, I'm going to keep milking this thing until I get up to here, right? You could, right? But what's happened is that your edge is gone. Now, you've banked money on it, yeah, right? But from this point moving forward, your edge is gone. The market went through that freak out of the world's coming to an end, right? Now it's gone back through to normality. Now people have seen those green candles and they're going, oh, okay, it's over, right? So IV returns to normal. Now, had you jumped on that, you would have made money from this particular trade. But at this point, I mean, you are up 43% in one day. I would call that a good trade, right? And be happy with it. That being the case, though, your edge is gone. You've gone back to contango now, right? The traditional kind of slope like that, okay? Not what we had like this, all right? So with no edge, get out. All right, so that's that example. Right, okay. As the commercial says, but wait, there's more. Okay, there's more to this, and I found this really interesting too, but that's probably because I'm a geek. Now, look at this calendar here, right? And this calendar, the magnification, if you use the software, you probably know that you can basically zoom in and out and all that kind of stuff, right? So it is the exact same zoom level, right? Now, but remember that this calendar was placed, sorry, this is the after effect, right? The calendar was this guy, okay? This calendar was placed when it was, the IV was sky high, right? If you remember, IV sky high up here, right? So when IV is sky high, this is what a calendar looks like. Now, notice the slope of this, and notice that it's pretty fat, okay? Now, without changing the magnification level, now let's look at what most people tell you, which is you initiate calendars in low IV. All right? Tell me you don't notice the difference there. This thing is skinny as hell. It's anorexic. Okay? What is going on here? Why is it that when we put on a calendar in low IV, our gamma here is 2, and it's skinny as hell? We've only got 30 points from where we are through to our break-even. Right? Let's compare that through to the other guy. The other guy, gamma is 0.86 compared to 2, right? It is 43% the size of the former, right? And what's the distance from our break-even through to here? It's double. It's 60 points. And look at how smoother this line is over here, right? And this is reflective of the gamma. The gamma is, now notice the expiration is the same, okay? I've basically done, if I go back, right, it's roughly the same. I got as close as I could, right? 38 versus 36 days, right? One is low IV, one is high IV. But the calendars look completely different, right? Why? Okay, well, let's look at that. So, why does high IV give us low gamma and vice versa, right? High IV, low gamma, low IV, high gamma, right? So let's try and understand that. So here's at the money. Okay. Now, if I basically drew the, the one standard deviation kind of move, that gives us roughly that spread, right? Now, what delta are we going to be having at the money? We're going to be having a delta of 50. What delta are we going to have at one standard deviation away? Roughly 16, right? Put those in. So what that implies is that the amount of delta, let's call it points, between here and here is 50 minus 16, right? So that means it's 34 delta points between those 2 points, right? Now, if the underlying, let's say, is SPX here, and it is completely random, right? But let's call it SPX. What's the same spread between those 2 points from a price perspective? Let's pretend that it's 50 points to keep the numbers simple, all right? So let's think about what gamma means. Gamma is the rate of change of delta, right? In this simple example here, what that implies then is that the gamma is the rate of change of this compared to this, right? We are at 50, we are then morphing to 16 over the span of 50 points, right? So the rate of change is 34 divided by 50, which is 0.68. Okay? Hopefully that makes sense. So that's low IV. What happens in high IV, right? Low IV means low movement, high IV means high movement, right? Hopefully that makes sense. So when we have high IV, if this is our at the money, and we now draw our one standard deviation, our standard deviation is much wider, right? And that should be self-explanatory, right? But what does that mean? That means that our 16 delta is much further away. So now instead of being away at 50 points, so we still have 34 points over here, right? In terms of the travels from 50 all the way to 16, it's 34. But now we're spanning across 100 SPX points, not 50, right? So what that implies, if we now look at gamma, is that the gamma in high IV here is 34 divided by 100, and that's 0.34. Okay? So hopefully that kind of helps explain why the heck does a calendar look so much more attractive from a gamma perspective, right? Smaller gamma, easier to trade, right? In a high IV environment than it does in low IV, right? Low IV, you get this compression over here. It's like an accordion, right? As IV expands, the accordion expands out, and our gammas get lower. Does that make sense? Any questions on that?
It does.
Cool. All right, so here's VIX Central, and here's a typical look at the term structure. And here we're looking at the term structure of the SPX, or VIX, and this is what normal looks like, okay? As I said, the second that you basically see that the front month flattens or the front month increases such that you've got positive skew here, then at that point, this is where you can potentially consider jumping on through to a calendar and looking for that edge, okay? Now, IV and time are closely related, right? So if I go back to this kind of thing here, just as we've seen that when you increase IV, you get this expansion effect of gamma, right? So sorry, you get the expansion effect, which means gamma gets lower, right, with higher IV. The same thing happens with time, right? So if you increase time, the same thing occurs, and that hopefully is something that makes sense to you guys too, right? So if you think about it, think about what IV is. IV is the expected range of movement on a yearly basis. It's annualized, right? And then you divide that by the DTE, right? The amount of time that you're basically looking at. That's going to tell you roughly how much it's going to move, right? If you now say, I'm comparing the expected movement, and within one standard deviation, of course, right? I'm comparing the standard movement of a 30-day option through to an option that's 2 years away. Well, of course, you'd expect the movement to span a much, much, much wider span of price within a span of 2 years than you do within 30 days, right? So these two things are completely correlated, right? As you go out in time, gamma gets lower, and as you increase IV, gamma gets lower as well. But time and IV are kind of like tied to the hip in this example, right? So when you're looking at this, and I know, Tom, that you've kind of talked about futures and cost of carry and all that kind of stuff in terms of explaining the term structure, and that's accurate too, right? But kind of relating it through to just stocks themselves, I think that's kind of another good way of looking at it too, right? Just realizing that as IV expands or increases, naturally that goes hand in hand with time being further out because we expect the range to be greater. right? And that's why when you get this kind of thing like this, where you get flat, this is basically saying that the range of expected move in the first month, let's call it 30 days, is X, but then you're not expecting anything in the 30 days after that, right? Which is wrong, right? I mean, obviously it has to have some degree of movement, and this is why this thing will basically revert through to normal contango, right? Hopefully that helps. So, my favorite myth: initiate calendars when IV is low. Busted. All right. Again, to recap, high IV basically means lower gamma, much bigger distribution between our break-even and where we are, and the ability to play the term structure itself, right? So you've got pretty good edge with those three things combined. All right, so we've been calendars, right? Some people say, I hate them. Hopefully, now that you understand them a little bit more, you may not hate them as much, right? But you might say, well, I trade iron condors, right? Does weighted Vega affect me at all? And you may think, and some people have said this, that is not the case. That weighted Vega is only relevant for calendars, right? It's only relevant for when you're dealing with multiple expirations, right? Not true, right? What happens is that the further out in time you go, even if you're in a single expiration, you will absolutely get affected. So we're going to see that. So what we're going to do here is we're going to look at this scenario here, right? We are going to set up an iron condor on this day, right, where we say, oh yeah, price is going to, you know, kind of stabilize and live around here. Next day when we wake up, this occurs, okay? Right goes down 36 points, and over here the IV goes up by 4 points the very next day, right? And what we're going to do is we're going to compare a so-called standard iron condor out at 30 days, a standard 10 delta iron condor, through to a so-called dangerous long-term condor, right? Where if this happens, you are going to get smacked, right? You have so much negative Vega that when this happens and IV goes the other way, you get creamed, right? Well, let's look at that. So, first scenario, 30 DTE 10 delta iron condor, right? That's what it looks like. If we then basically say, change the vol by 4 points, what this is, and you know, move down by the amount of points that we know will actually occur. What does the software say? And by the way, again, not knocking any software, all software will say the same, roughly. This basically is saying you are going to be down 12% overnight, right? Why is that? Well, okay, well, because we're negative Vega, right? Pretty big, right? And now we're going to be down, because Vega IV is going to go in the opposite way of what we expected, right? And we're also getting hurt by delta, right? So, but the main point here is the software is saying you are going to be down by 12%. So let's look at what reality is like. That's reality. Pretty accurate, right? Doesn't that contradict what I was alluding to before? That for iron condors, weighted Vega is still relevant? Well, it is relevant only if you're further out in time. If you're at roughly 30 days or less, weighted Vega in a single expiration, you don't need to know squat about weighted Vega, right? It's almost irrelevant. It will not affect you. And you can see here that the software is highly accurate, right? It got it almost bang on, okay? So now let's look at the dangerous long-term iron condor. All right, long-term iron condor, 5.3 months out, okay? 10 delta. And our Vega is quite a bit bigger than our prior one, okay? Danger, right? Negative Vega is too big, right? Vega goes up, we're going to get smacked. Now recall, the prior 30-day iron condor was down 12% overnight. This condor is down $210, 1% down. What? I thought it was dangerous, right? Let's compare them side by side. All right, initial Vega of the long-term iron condor is bigger, right, by a decent margin. Yet, 30-day is down 12%, the long-term is down 1%. $210 versus $2,000. Right? But wait, there's more. So what the heck is this, right? What this is the theta distribution of a 30-day iron condor, the same one that well, a similar one to what we looked at before, okay? So in TOS, I've basically gone in and basically changed it from P&L through to theta. What this implies is that anywhere here, if price stays in this range, we are making money. We're making theta. Of course, delta has to be taken into account, but purely from a theta perspective, okay? You're making theta in that range. The range is from there to there, okay? What does that mean? 196-point range that you're making theta money with a 30-day iron condor, right? What's the dangerous long-term one look like? That, right? This one over here, the theta distribution is now basically going to give us 440 points of theta distribution versus 196. 2.25 times wider theta distribution with a so-called dangerous long-term iron condor than a 30-day iron condor. Okay? On top of that, remember what we learned before. If you increase IV or you increase time, what happens to gamma? It goes down, right? So a long-term iron condor has smaller gamma, which means it's easier to trade, right? Like if you trade that gamma, or if you trade this gamma, I know which gamma I want to trade, right? So that's a hell of a lot safer than this. For this kind of stuff on the bottom, you've got to be pretty skilled from a technical analysis perspective, okay? For the top one, not so much. So which one's safer from that perspective? That one, right? Small gamma always is going to be safer to trade than the other one, right? Is Vega, having a bigger Vega, a big deal that everybody says, oh, don't do it because it's so dangerous? No. The software may tell you you're going to get creamed, right? Let me kind of step back. I'm not sure if I made that clear. Notice what the software is basically saying. The software was predicting you were going to be down by $1,500, which is also not nice. Now, why is it 1,500? Why is this number here not bigger than that number, right? Well, because we're looking at two combined things here, right? We're basically looking at delta impact and Vega impact. We're getting hurt by Vega, and in this case, we're getting hurt by a delta, right? We are, over here, we've got some positive delta, yet we're going that way, right? We're going down the slope, not up it, all right? So from here to here, we got hurt by delta, and we're also getting hurt by Vega, right? And since the gamma is so steep on a 30-day compared to a longer term, we're getting hurt more by delta and the higher gamma, of course, than the other one, right? Because the longer term iron condor, oops, this one, notice that the curve is much smoother, right? Therefore, the move down in price, the gamma and delta impact is relatively minimal compared to the first, okay? But from a Vega perspective, the software was basically telling you, even though you're not going to get hurt too much by delta, you're going to get pretty whacked with the Vega impact, okay? Yet, the reality was very different, right? He hardly got affected by it. Why? Because it's so far out in time. Okay, so weighted Vega does affect single expiration trades such as iron condors, providing that they're, let's call it 60 days out or more. Okay, so I still feel it's a useful thing to understand. It's not just a calendar thing, but it's absolutely a calendar thing, right? So that's that. So better theta distribution. So again, we've talked about long-term iron condor, right? The dangerous long-term iron condor. Smaller gamma, good. Delta doesn't hurt us as much because it's a smaller gamma, that's good. Smaller initial theta, that's bad, right? So if you look at, did I include it? No, I didn't. The theta is about a third, roughly, of what you're getting with the other one. But remember, what we're looking at here is the fact that the theta distribution is much, much wider. So we're making money across a much wider span of price, even though we're making less per day, right? And due to weighted Vega, then the impact of Vega is far less, right, than it is for a 30-day iron condor, right? So you put all these things together, and can you basically confirm what some mentors say, that long-term iron condors are dangerous? No. complete opposite. Right? So you'd be crazy to trade on condor, which is really way out in time. Busted. All right, so that is pretty much the key myths versus facts that I wanted to cover. I'm hoping I've been able to achieve a bit of this in at least some of the things that I've presented here. Right? My purpose is to try and challenge you. Again, don't take my word for anything. Please go out and verify everything I'm talking about here for yourself. But hopefully a few of you will have that light bulb moment go off and either understand calendars just a little bit better in terms of weighted Vega, or if you're doing longer term trades, understand how weighted Vega affects that as well, plus the various other things that we talked about with IV, time, gamma, and various other things. All right. So, in summary, weighted Vega is basically the ripple effect type of concept that we talked about at the front, right? If you are close to that impact point, you're going to get hurt. If you're far away, you are not going to get hurt as much, okay? That was this one here, right? This one is definitely unfortunate, right? There is no software out in the retail market. I'm sure that the high-frequency traders and all that probably have software that does everything, right? But since I don't have a few $1 million to spend on that, then it's not available to us. So you do for now have to use things like spreadsheets and all that kind of thing when you're looking at weighted Vega. But again, I'll make the spreadsheets that I've presented to you available, and you guys can play with that. And hopefully people can take it to the next level and start making them even cooler. All right. Trading calendars with the concept of weighted Vega, very tricky stuff. Again, I'm no one name in particular, right? A guy that makes money day in, day out trading calendars, right? Circled conventionally. And that's fantastic, right? I am not saying that the way people trade and make money is wrong. Absolutely not. I'm just trying to show you why wacky stuff happens with calendars. So you hopefully get a better feel for that, right? Many calendars, again, are relatively Vega neutral. So that should be definitely something that you kind of take away. Be careful with trading earnings, right? It is not the guaranteed moneymaker that people, some courses out there claim. All right, and the concept of having a relatively Vega neutral trade is something that can basically be part of your arsenal, right? So again, an out-of-the-money call calendar is relatively Vega neutral, right? So it's going to be positive theta, going to give you those positive deltas on the way up the slope, and relatively Vega neutral, right? That's not a bad thing, right? So get creative with it and play around with new structures and all that kind of stuff, right? Again, one of the best edges here with calendars, in my opinion, is to leverage term structure skew, right? So look for that flat slope in the term structure before it kind of starts doing its usual thing. When you see that, especially in indexes, that's something you can potentially jump in on, right? Do be careful though with stocks, because sometimes what happens is that, let's say it's a drug company and they're expecting some sort of drug, announcement of, they're going to fix cancer, cure cancer or whatever. IV can go sky high, but then IV can keep going sky high, right? With these kinds of things, it can kind of be weird, right? Until things get back to normal. So you could be sitting through a hell of a lot of pain before things return to normal, and go way past your planned stop loss, let's say, right? With indexes and that kind of stuff, I think it's far easier comparatively to stocks, but there's, a lot of the time there are overreactions with what happens in stocks too, right? As a matter of fact, I personally wanted to jump on the Apple one today, but I missed out because I couldn't get in early enough. I had to have some work meetings, but that could have been perfect, right? Again, complete overreaction through to the earnings announcement. They actually hit everything they said they were going to hit, but the street expected more, right? But they hit everything, right? Apple, great company, they sell a $600 product every year, 35% quarter-on-quarter growth. That sounds pretty phenomenal, right? Yet the street hated the number, they were expecting higher, and boom, right? 6% down. Is that an overreaction? You bet. Could you have potentially gone in and looked for that term structure differential? Yeah, and you probably would have been out by lunch, because when I checked it at my lunchtime, which is later in the day for the actual trading day, because I'm on the West Coast, there was no term structure benefit anymore. It had already gone back to contango. Okay, so I couldn't jump in. But to me, I think that's a pretty cool edge to try and leverage. And as I said, the weighted Vega concept is going to affect more than just calendars. Anything from about 60 days or more out in time is going to be affected. All right, we are done, people. So I'm happy to take any questions if they're there. Otherwise, I'll let you munch on that and think about it.
Well, a lot of thank yous, and David Seward said he's going to Tanglewood tomorrow, but he already saw a Bravo performance tonight, and I think that's how everybody feels. He did an outstanding job, Ron. Really appreciate it.
Yeah, my pleasure.
So there are a couple of questions. Ray McCarty asked, are you trying to make profits from the short leg or the long leg? I'm not sure what he was talking about. Maybe on the, was that on the Iron Condor, Ray? Let's see, what else? A lot of comments here. Mostly just kudos. So, oh, he said no on the calendar.
Say it again, sir? Yep.
Yeah, so on the calendar, are you making progress on the short leg or the long leg?
For which trade?
Yeah, which trade, Ray?
Well, you know what? Probably the easiest way to answer that is I've got the full report that will go through a whole variety of sample trades. Everything is in detail there, and then of course they'll have access to the slides here, so he'll be able to reference that after we're done as well.
That sounds fine, and then we're about a half an hour longer than we normally go anyway. So.
All right, sorry about that. I knew I had too much already, but I thought I wanted to squeeze it all in.
It was good stuff. It was definitely worth the extra 30 minutes. And like Rick Van Vieren said, there's a lot of good traders here, and you're getting lots of kudos from this group, so that says a lot.
Cool.
And Andrew had one more question. If you're trading term structure rather than absolute Vega levels, do you always use a ratio of 1-to-1 rather than weighting?
If you're trading term structure, then you're basically trading term structure just through the standard calendar concept. You can use diagonals and that kind of thing, but the standard that I've seen people do that want to take that edge is they just do a straight calendar. Now you can do, I don't know if you noticed, if any of you were kind of looking closely at that one that was up crazy amount, right? It was slightly out of the money. It wasn't at the money. This was for that when Ivy was sky high and when we were expecting the backwardation to go back to contango, right? The reason that I did that, I didn't kind of want to get too deep into the Greeks, but there's another Greek called Voma, or Voma, I don't know how it's meant to officially be pronounced, but think of it as the rate of change of the Vega. So it's very similar to like gamma with regards to delta, right? So it's basically the second derivative. So it's a rate of change of your Vega. And what you'll find is that the biggest Voma is in out of the money options, right? So you'll get a bigger bump, if you want to think about it that way. So when things revert, they'll revert more quickly when it's slightly out of the money than being purely at the money. So that was the reason that I went about 10 points higher. Plus, I was predicting a bounce, right? That was the whole point. I thought we were at support, so if price was going to bounce, you wouldn't put it at the money. You're chasing it already, right? So those are the two reasons why that was placed just slightly out of the money.
All right, very good. Well, I think that we're quite a bit over than our normal limit. So why don't we wrap it up? And Ron, if you just email me whatever you want me to post with the recording, I'll put the links in the description so people can get those and continue the research. And we'll get you on again for your volatility modeling. That sounds very interesting as well.
Sure. Yep. Not a problem. All right. Thanks, Tom.
Okay. Thanks everyone. I'll get this recorded as soon as I can. So thanks again, and we will see you next time.
All right. Bye-bye.
All right. Bye.